Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Daniel Morris, Chief Market Strategist and Co-Head of the Investment Insights Center at PNB Paribas Asset Management to discuss 2021 economic outlook and just how far the value versus growth rally can go. Daniel, it's great to have you with us. Welcome to Trade Talks.
Thank you. Thank you.
Why do you expect short-term economic disappointment? Are markets focused more on the longer term at this point?
Well, you certainly do seem to have a disconnect, though, frankly, we've been talking about that for several months. On one hand, if we look at the short-term economic data, certainly plenty of things still to be worried about, but markets, for the most part, continue to go up because they're thinking about how they expect things to be in 6 months, 9 months towards the end of the year. And broadly speaking, we think that's the right perspective to take, but that doesn't mean there are not going to be moments when perhaps markets get a little bit ahead of themselves, or on the other hand, the accumulation, particularly around the pandemic, of negative data could get to the point where markets need to reassess that optimism and perhaps recalibrate a bit.
And rallies have been strong in sectors to those anticipating fiscal stimulus, infrastructure package, the Green New Deal. Do you think it's time to pause a bit here?
Well, I think that's exactly what we're trying to assess. What are the markets pricing in exactly? And on one hand, if we look, say, at the fixed income markets where you don't see the same reaction, it does suggest that markets aren't necessarily assuming you're going to get all 1.9 trillion and then an infrastructure package at the end of the year. But that's quite difficult to tease out. And as you identify, it really does depend on the sector. Certainly anything that is anticipating funding around a Green New Deal, generally speaking, has done quite well. Also, sectors that are going to benefit from wider availability of the vaccines and a return to what we hopefully see as more normal activities have already rebounded quite a bit. So that it's that assessment between pricing in those expectations and the reality where you need to be quite nimble.
Right. And then the question to follow up to that is how far can the value versus growth rally go? I mean, small caps really have been participating since, I would say, October, November, and we're starting to see, a more broader rally across stocks. Do you think value and small caps still have some room to go here?
I think there are going to be different drivers for those two markets. When we think about value, certainly it's going to depend on what happens with inflation expectations and treasury yields, also what happens with energy prices. And there we think there is scope for further outperformance of value versus growth. But at the same time, we don't see this as a multi-year trend, simply because on one hand, of course, the Fed is still pursuing quantitative easing that implicitly puts some sort of cap on treasury yields. Secondarily, if we try to remember what the economy was like before the pandemic, we had very low unemployment rate, but inflation really wasn't accelerating. Now, of course, we have a much higher unemployment rate now, but even when we get back to rates closer to what we had in 2019, that doesn't mean necessarily that you have a big acceleration in inflation. And I think that explains what we see happening with treasuries in general. So a limit ultimately to how long and how far value can outperform, just because there is only so far, we think, that treasury yields can rise. The other market you mentioned, of course, is small cap, and there the dynamics, I think, are rather different. We are anticipating, nonetheless, a pretty significant stimulus package to come out of the Congress that primarily is going to be focused on domestic demand, and small caps really should be leveraged to that recovery more than large caps, which are going to be looking towards external markets that in general are still relatively weak. So we think there's more potential for a catch-up. Though that said, you noted that you've had a pretty big recovery already for several months in small cap. And what used to be quite attractive valuations really aren't so much there anymore. So as it generally is for stock pickers, trying to find those parts of the market where you still see reasonable valuations relative to the growth expectations.
And Daniel, finally, what are your thoughts with emerging markets in China?
Well, China has already been lauded as a country that seems to have managed the pandemic relatively well. Economic growth in the markets generally already reflect that. That said, we do think there's going to be an acceleration of growth in China next year. Forecasts in some areas look at 8% growth for 2021. So certainly that's going to benefit the market and importantly, benefit the rest of Asia in particular and emerging markets more broadly. The second key advantage that I think emerging markets have at this point is valuations, at least relative to developed markets, do look more attractive. So as we try to assess that potential versus the price of that growth, emerging markets broadly for us still seem to be a place we would likely overweight.
All right, Daniel, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.